Good afternoon, everyone. Welcome to this Monday's Wealth Creation Show. Welcome, Jim. Where are you? Where are you today?
I'm in the beautiful Isla Canela in Spain.
This looks really nice.
See all these yachts sitting in the background. Nobody's out in them because they've got all the money in the world, but we've got no time to enjoy it. There's a lesson there.
I was going to say, is that the marina behind you? So, but yeah, no, that's true. What you say, a lot of people maybe have a lot of money, but they spend so much time still working and doing things. So, but today's topic, we are going to talk about, I titled it, Patient Investing Pays Off. And the best person to discuss that with today, I think, is yourself, Jim, because it is about the long game and not thinking about quick wins and making money fast. It really is investing, investment. It doesn't matter what you're doing. I know, obviously, property is your main thing, Jim, and a lot of people watching probably also. But I think in any spectrum of investing, it is, and not even medium to long term, Jim. I think long term. I think we spoke about this before. People say, medium to long term. Medium still, if you really want to be wealthy, then it's a long term thing.
I think there's only two options. There's a long-term investment to grow your wealth, and there's a short-term view to create income every single month. And you can have a balance between the both of them, or you can have the opposite end of the spectrums, I suppose, depending on what your own criteria is and your own circumstances, what you want to achieve out of it. But there's always a trade-off, isn't there? You know, as you said, passive investing actually pays off far better in the long run as compounding wealth over time. Whereas if you start to take small bits of income out, then it's obviously a less an opportunity to compound on that income. And we showed that in a classic example of running out and buying a Lamborghini Huracan.
Yeah, that was a good one.
178,000. How 178,000 in over 20 years cost you actually 2 million. So that 178,000, you lost the opportunity to generate £2 million out of it over that period of time. So you know, it's the trade-off you have in terms of. However, do you know I've just read about how billionaires buy yachts and the reasons behind it. It's cheaper to buy the yacht than pay the taxes, because then you can become a tax exile because you have no domicile anymore and your yacht is your home. That's why they do it.
Okay.
So, because they're saving 10 million a year in tax. So if you're saving 10 million a year in tax and you buy your yacht for 6 million, your quid's in.
Well, that I suppose, I mean, if that makes sense to anybody watching, then that's obviously why they do that, and that's quite savvy thinking to navigate around that situation through the tax.
Whole different league. Yeah. Whole different league. It's like, my God, I cannot believe that. You get your eyes opened, I'll tell you, into what goes on. Definitely.
Yeah. So yeah, patient investing, and I think the last few years have been really eventful, I think, to say the least. I think between the pandemic and war and energy crises and rising inflation, and the financial markets have seen considerable ups and downs. So stability seems to slowly have begun to start returning. But the fight or flight instinct has already been triggered by so many investors at this point. And it's only human nature for them to look for the next opportunity or threat or do something rather than just let the market take its natural course. So how can we channel our energy, Jim, into what we should be doing and not get caught up in what we think we should be doing, if that makes sense? I think, like you say, it's natural instinct to, like, what will I do next? I need to do something, and that panic kind of takes over.
Oh God, sometimes the best thing is actually sit and do nothing. You know, that's everybody thinks they've got to hustle or they've got to do something, but patience is a virtue. You know, it's something it's underrated. And I've often told many investors, property investors, they're desperate to buy their first property, and they're running like I don't actually see them run about like a headless chicken, but metaphorically, they're like that on social media. I need to buy a property. I need to buy a property. How can I get started? And how can I do this? And how can I do that? And I'm like, whoa, just slow down.
Yeah.
Just get the numbers right. Now, here's and then I just share them on the playlist for obviously the Wealth Creation Show playlist on YouTube. And I say, look, sit and watch that first. All these episodes. I mean, you've got about 85, 86 episodes now.
86 today.
If you sit and watch every single one of them, that's 86 hours of learning. That's effectively 2 modules in terms of Scott Beck Awards in Scotland.
Mm-hmm.
That's 2 learning modules. And I'll tell you, you'll probably learn everything you need to know in terms of risk investment, sensitivity analysis, risk return, and how you should be investing, what you should be investing in, and how to look for the best deal out of everything. I think that's where you should first start if you're starting off, because it's free information, it's free advice, it's all based on own personal experience. So it's no anything that's made up. It's actually what I've done.
Mm-hmm.
So my great thing is always find out the most wealthiest person you know, and then see what they did and more or less replicate it, and you'll probably get the same result.
Yeah, no, that's definitely good. Some good advice there. And the playlist for the Wealth Creation Show is free learning for anyone. You get it on the YouTube channel. I mean, even me doing these with you, Jim, and speaking to you, I learn a lot. So, and I'm sure everybody watching does not. And I know because I get feedback from people that watch and they're like, "Oh, that was great today." And you know, see if you even take one thing away each time and implement it, and that'll compound up to your own success as well. Definitely.
Yeah, definitely. Yeah, I would agree.
So, invest in. Today I've put it as an example. Like I've used the example of surfing. Investing in a business, like any business, can be a bit like surfing. And with surfing, I'm trying to think of an analogy to compare it. And surfing has a lot of ups and downs. And if you try and surf in calm seas and play it easy, then you're not really going to get anywhere fast or anywhere really. So to feel that really high of mastering something and maybe like in surfing, hitting the big waves and things, you need to be prepared to take a dip sometime and take some risks. Although you know sometimes it's out of your control, you only know your own actions can obviously take you there. So sometimes it's basically push yourself. A lot of people don't want to push themselves. And volatility, like anything, and investing in property or whether it's stocks, it's a feature of investing. So you really need to be prepared to deal with that, the ups and downs, basically.
Definitely, it's ups and downs. Let's look at the pension funds just now. Mine's is linked to the stock market. Obviously, some of the high value ones like AstraZeneca, Diageo, Glencore. There's some sort of vape company now that's one of the top 10 investments in the fund. But which is the biggest vape company in the world, I think.
Yeah.
So they can see where the investment is. But there's no doubt the fund has actually dropped a wee bit. And I could get a bit out of shape and think, oh, I've lost, £8,000 since that time I've put money in. And it's like, who cares? Because it'll just recover, and I'm not going to be returning anytime soon. So I've got another. Well, if it's the normal 65 thing, remember you don't need to retire at 65. It's only money that stops you. If it's a 65 thing, I could draw it anytime I want after 55. But if it's a 65 thing, I've got another 9 years. So why would I bother at this point in time? It makes no difference. I just look at the fact that I put £4,000 in there now, and I got another £1,000 for the tax man for nothing. Plus the fact I'll get a deduction from the higher rate to bring me down. So there's another £1,000 on top of that as well. So I put £4,000 in and got £2,000 back.
Yeah,
that's a good deal.
That's good, yeah.
And then my investment is actually 5,000. Yeah, it's a hard one to work out, but
yeah,
it makes sense. Yeah, it makes sense. Yeah, it does make sense.
Yeah, but like I say, volatility it's a feature of investing, and it's not a flaw though. People might think, oh, do you know what? Because if you hold on to your money in cash and if you've got it sitting, then you might escape that obviously risk of the volatility, but you won't see much growth or returns in your money, and it'll be eroded by inflation as well over time.
I've seen it loads of times. You see the get rich quick people. They'll immediately run in and they buy a share, a stock. They've been they maybe been reading Investors Chronicle, or they've been reading the Motley Fool, and somebody tips them for a share tip, of a company, and they run in and buy it, and they buy it and they look for the short term gain because they use money that they need more or less from day to day to buy it. So they've only got a finite amount of time they can use this money to invest, and then they'll have to pull it back out. But it doesn't go according to plan over the next 7 days to 2 weeks. And then there comes a point they've got to pull it back out and end up pulling it out at a loss. And this is what I mean about you've got to understand that you've just got to ride the volatility and the storms. It's like exactly what you said, the analogy of surfing. But I tell you what, if you can predict the wave that's about to come, you can make sure you're prepared and start paddling so you can ride that wave all into the shore.
Yeah.
And it's that is the expertise and the skill you have to understand. It's how to understand and know when that wave is coming. Or if you miss that wave, when the next wave comes, or when there's a wave that you can ride just now until the next wave, the huge tidal wave comes after. And that's the opportunities you've got to see. Whereas everybody just keeps talking about it all the time. Oh, there's going to be a crash. There's going to be a crash. It's like, oh God, we've been talking about a crash for about 5 or 6 years now.
Yeah.
It's still not happened. And pundits believe that if there is going to be a correction, there's going to be, this guy apparently out of 1 in 8 billion people in the world has written a book, and he's predicted the last 2 crashes. And it's like, I think I could probably find 1 in 8 billion that's probably said the same thing. It just so happens that they've plucked him out of thin air and, he was right. So he's obviously going to be right about the next one. Well, he's probably not, but he says it's going to be 2026. I could understand, we could probably have a wee uplift in the market for the next 2 or 3 years. I could see that happening, especially in the lower end of the market because it's more affordable for people. So that boom will continue to go on in there as it did in the 2000 to 2007. With the flats and apartments, because you know yourself, I bought in early 2000s, I bought places at about 9 and 10,000, and then within about 3 or 4 years, I sold them for 50 and 60,000. That was a good pay.
Yeah,
that was a good payoff. I paid for my place in Spain. That's why I've got it.
So no, that's how it works, and I think if you have got the expertise to gauge what's coming better than anybody else, then you could be prepared, and it helps you and where you are. Because sometimes people that just hastily do things and don't really realize what's coming in the market or what, and they've not they've not say totally risk adverse, but they've not maybe done a proper risk analysis of their situation, they could get, a change in the market like we're going through recently could just totally wipe somebody out, and it has done a lot of people. Whereas there's other people like yourself, Jim, and a lot of other investors who have safeguarded themselves against.
Is it the fact that they listen to the masses? And then they jump in straight away after listening to the masses, and they then just go with it based on what the masses say. But I keep going back to saying this, what John Paul Getty said. He was the richest man in the world at one point, in the early 30s, in the Depression. But the reality is, he used to say, observe the masses and do the exact opposite. That's the only way you're going to be successful. Because then, if the masses are successful, guess what? You're just exactly where you are before. Because everybody's waging, and you're going to be any different. Because if you give everybody £1 million, then guess what? We're all millionaires. Okay, that means every price of all the goods is going to go up to reflect the fact that we're all now millionaires. See how inflation works?
Yeah.
So the more you pump into the economy, and the more that does that, the worse it's going to get. I tell you what, as well, one of the things and trends that you've got to see here is the wage negotiations still going on with the rail unions workers. They're still going on from about 3 or 4 years ago to be settled. I was quite surprised about that. So that's all be settled. So that money's never come through. So when that gets settled, that money's all going to flow into the system even more. And potentially, I think they're talking about 5 and 4 for the 2 years that have just passed. And I think even though it's 5 and 4, it's still going to fuel inflation because it's money that wasn't there in the first place. So you've got to look at things like that. What's yet to come, and you've got to look at what's getting pumped into the economy in terms of, are they printing more money in order to do this, or are they actually taking money out of the economy, which will actually bring inflation down? I could still see it right now where they're still continuing to put money into the economy, and just by the natural conclusion about what's happening with wage negotiations and salary negotiations, hence the reason why the government actually said, could you kind of observe restraint. It's like, not exactly the best thing to tell everybody while you're giving yourself a bumper pay rise as an MP.
Yeah, I know. I mean, so what kind of effect does that? I mean, you're saying obviously they're pumping new money into the system. I mean, surely they can't just do that willy-nilly, or what's the, I mean, what's the implications or the repercussions of doing that quite freely, or is it something that's needed?
Well, the money's sitting in the government or the real body's hands just now in the companies.
Mm-hmm.
So they're going to put it into the hands of the people eventually, because that negotiation's still to go. Now we're still at 5 and 4, and there's thousands of workers to get this right across the whole salary bill. So when you look at that and how much money they're going to get back in their hands, the first thing people do is they go and spend it.
Yeah.
So if they're going to spend it, you know what happens? You know, prices go up to reflect that there's more money in the economy to spend there, because there's the same amount of goods and services there. So supply and demand. That's how in simplistic terms it works in economic terms. If there's more demand than the supply, prices go up. Look at the boom. Look at house prices, how they went up. Look at the rental market. Less supply, prices go up.
Yeah.
More demand. So it's that classic example about how that works. So I think inflation's here to stay for a wee while longer than what we're expecting, and that's why I think base rates will continue to go up. And that's why I started at the start of the year and kind of foresaw this coming and ran to fix as much rates as I can get for the next 5 years.
Yeah.
This is the volatility thing. I'm not prepared to do volatility with that, because it's a lot of money. It's over, probably it's about 2 million. So I would rather have a fixed certainty for the next 5 years than actually go in with the prospect of, I'm just going to leave that money open to the markets to decide where that's going to land in terms of what I'm going to have to pay every month. I would rather know what I had to pay, because I like the certainty. So that's why I've done that.
What you're actually paying,
That's why I've done that, for that reason. You wouldn't want to leave it to chance, whereas other people would speculate and think, oh, see if I can make a wee bit of money on here, and
it
duff
might
and
go
dive
the
there.
other
And
way,
it's like,
go in my favour.
but the thing is, once it's gone up, you're screwed. It's like you try to fix, you can't fix it again at that rate you had before. In hindsight's a great thing, but you can't go back. So so it's the long game as well, and the fact that, well, for the last 20 years, well, no 20, let's say 2000 and after the credit crunch, what, 2009, 2010, where the interest rates dropped like a stone? Yeah. For over the last 10 years, I've enjoyed a record low interest rate and everything, because I've had index funds, index linked on everything. It's been base plus 0.9 and 1.99 trackers for life, interest only. So I've enjoyed all that record period. So why would you not have that, uplift where you've got to have the swing and you're going to have to pay a lot more than what you paid before? But a lot of people don't plan for that. They don't look into that at all. They just think, and now I have to offload because I've actually leveraged myself up far too high than what I expect. Whereas I didn't. I didn't do anything like that at all. I sat on my hands for the last 10 years and stored and piled cash.
Which was the smart thing to do, because now you're in a position where you're not having to exit the market, because like you say, you've over leveraged yourself, and a lot of investors who are having to exit the market now, and property and things, that's exactly what the situation is, and they've not thought ahead.
Now, I'll qualify this by saying I stockpiled cash. I never really stockpiled cash to such. What I did was I reinvested back in my property. In other words, I'll tell you what happened. I reinvested back in my properties over these 10 years by putting a whole lot higher level improvements and repairs. Repairs are essential. Improvements are, they'll add value. So I've looked at where the opportunities was to add improvement. So then, where I had all that position where my equity was really low, it was like something 20% loan to value. I mean, that's a great position to be in.
Yeah.
Then I thought I could use some of that now and leverage it and actually just get additional borrowing at a preferential rate, because my loan to value was a lot lower than expected, and still keep within the tolerance limits. If interest rates go even higher and higher and higher, I'll be fine. If occupancy rates drops as a natural result, I'll be fine. All these different things that I factor into the equation to put a lot of de-risking, let's say. So I de-risk everything to the point that it's going to have to be catastrophic before anything would affect me. But I'm on the universal principle that if it's catastrophic, it has to be catastrophic to everybody else beforehand.
Yeah.
So we're all going to hell in a handbasket.
So if things were to take a turn for the worst, everybody would be in the same boat. You're not just out there on your own. Yeah.
But you know what happens? The government steps in and protects everybody. So that's what you want to be. I learned that off an old analogy. You know how I learned this? I'll tell you the story how I learned this. I remember one of my friends, it was when we were teenagers, so don't castigate me for this. One of my friends ran at the Chinese restaurant and went, "Can I get a portion of ching chong, ping chong, ping chong?" And just jokingly, we were only about 9 or 10.
Yeah.
And then the boy jumped over the counter with a meat cleaver in his hand and ran after us. And there was a whole load of us running. And he was the last one in the line. He was the last one in the whole line. And I was the second last. And he got caught, obviously, and then they stopped with him. And then, I thought to myself, how on earth did that happen? And then I remember somebody turning around to me and said, "Jim, see in that scenario, as long as you were running faster than him,
as long as
you
you're
were never going to get caught.
You
were never going to get caught." Yeah. And it's like that wee thing since teenage years, since early teenage years. Well, probably not teenage years, probably a lot younger than that. Since early, maybe 9 and 10, it's stuck in my mind all that time, right to now, which has actually been a valuable lesson that's been taught me investing, is the fact that as long as you're running faster and you're in a better position than everybody else, if everybody else starts to go at the wall, the government will step in to protect them. And I mean homeowners. So if interest rates go so high, it gets out of the box for homeowners, the government will have to step in at some point in time and do something about it. They can't let a 2008 situation happen again, because then we'll just go in that cycle again where they'll print more money and then we'll be in more trouble.
Yeah.
And then inflation will go up again and it all starts all over again.
Yeah, that's a big circle. It's a circle, yeah. But yeah, we spoke a lot about cash there, and I think if people have got cash in the bank, and we talk about obviously leaving cash in the bank and on savings or whatever, inflation eroding that. But I mean, if you need cash for something in the short term, then that's fine. But if you've got a lot of a pile of cash in the bank and savings, then you're better investing it. Now, obviously, like we've said, investing comes with volatility as standard, but you're more likely to see inflation beating returns by reinvesting that money. Like you said, you done, Jim, you didn't stockpile cash, you reinvested it as you made it. And I think it's important with that in mind when we talk about investing, that investing really means 10 years plus, ideally, to be successful. And investing in equities and property always outperforms cash over the medium to long term. I would say long term, really. And investing really as a mindset and requires patience and belief in yourself and belief in what you're doing, and that the knowledge that you've got the knowledge to obviously see it through that whole process.
I would say so, yeah, absolutely. I mean, if you're stockpiling cash, you should be using your cash and still putting it to work for you. If you have a mortgage, for example, I get now and again people come on and say you should pay off your mortgage. It's like, what do you mean, pay off your mortgage? If your mortgage is still at an extremely low rate, and it's because you're a homeowner, and you can make more money on that money that you've got, even though you've got the cash, you should at least go for an offset mortgage if you can, because you can at least keep that cash as an offset. Therefore, you're paying no interest on your mortgage. Therefore, it's making that return. But then you have instant access to the cash if you need it, if the right opportunity comes up for investing. So, because you'll get a higher return on doing that, won't you? You've got a higher return doing an offset against your own mortgage as you would trying to put it in for savings, because it's the simple rule of the banks, where your mortgage is always going to be higher than what they're giving people in a savings rate, and that's how they make their money. You take your money in, they tell you you're going to give you 3%, and then they lend it out on fractional lending at least 10 times to other people in value, because it's all hypothetical, remember, it's no actual money exists. They just lend out in fractional lending. So they create, if you give them 100,000 to save, they'll lend out 1 million to people on that behalf. So they're giving you 3, and they're probably making 6 or 7. So the differential for them is between 3 and 4% every single time. And they've effectively not really got that much risk, because they've maybe put securities and everything. So they've maybe done secured lending with a whole lot to people on mortgages. So that's how they're doing it in terms of that. So they always make more money. So it makes more sense if you're going to have money on deposit and you do have your own mortgage. don't run off to pay it, but see if you can get an offset mortgage, which actually means that you'll not be paying any interest on that mortgage at all, and you'll potentially be paying down the debt at the same time, because that's how they work. So they don't say, the offset mortgages, they don't say, oh, you don't need to pay interest at all every month. What they do is they take your normal monthly payment as usual, and they pay it down on the capital. So you're effectively paying down your mortgage at the same time on an offset mortgage. So you're still paying the monthly amount. You're not getting away with not paying it, remember. But you're actually saving that money every month, but saving the interest rate on it as well.
Yeah. And you've actually done that yourself, Jim, as well. Yeah.
This is 0% alcohol, by the way. I don't drink alcohol, just in case anybody's thinking, that boy's drinking while he's doing this.
On a Monday afternoon. I think on a Monday afternoon, anybody would take the 0% and sit in the sun. But, so let's talk a wee bit about, I mean, what happens when people chase quick wins? And we see people doing it all the time. And you spoke about like social media and things. The media is full of noise about people who are promoting what to invest in, and whether it's hot stocks or some new theme and trend or some and celebrity endorsed cryptocurrency or whatever. Do you know, there's loads out there. And firstly, an investment, I think, that's really heavily advertised on social media, and you see it on TikTok and these kind of investors and things. At best, it's probably unlikely to live up to its promise, and at worst, it's probably a scam. And I mean, you'll have seen a lot of that over the years, Jim, and how things have changed. Obviously, social media and things have got about, but even just the media, push that kind of narrative.
You've got to be very risk orientated, I would say, to invest in things like that. I wouldn't say risk adverse. I would say risk orientated, because the very fact is you're investing. The classic example I'm seeing right now is loads and loads of property investors that have no money, but they actually get people to fund their project. And it's okay if it's done through places like crowdfund, or because it's kind of legit. It's put together properly. Probably the paperwork's in place. They've probably approved it in the way it should be done, and because I think potentially they could be liable. I think that's Simon Zushi's platform, crowdfund property, possibly. So that's kind of legit, although I've not looked into it personally. But you do get the one and two, sole traders, just people coming on and saying, I did this project, and this is you'll see it straight away, because you go, and they look at the point to the numbers, every single, oh look, that the TikTok, this is what I got, this is what I did, and this is what I made. You could get that return on investment as well. That's what they talk about quite a lot, and we'll give you at least 10%. And it's like, okay, well, that has to be backed up with some sort of numbers. It can't be just a hypothetical. But there's a lot of people that aren't savvy investors, and they're taking their life savings and what they've got and actually just giving it to someone on the principle that, they might actually hit these numbers. And when I look at some of these numbers, I think to myself, you're never going to hit them.
Yeah.
Like, so how are you going to be able to give somebody 10% return on investment? I don't get involved in saying that to anybody. It's just like, I just stick to my own thing. That's what, because I do my own thing anyway. I don't invest in other areas. I don't invest in people doing property investments because I do it myself anyway. Why would I want to do it with someone else if I could do it myself?
Yeah, definitely. And I think there is always an element of risk. I think even genuine investments, they're not immune to the damage caused by people that still want to try and chase a quick win. Do you know what I mean? Even the best strategy, if you don't follow it properly over the recommended period of time, if you try and speed things up and push things to make quick money, then you're going to ruin that recipe basically, and it's not going to turn out the same.
Do you know what I was taught in network marketing? If it's too good to be true, it probably is. Yeah, every single time. And I don't care what anybody says about this too good to be true. It's true every single time. If it's too good to be true, it probably is. Unless you can see the facts being out right in front of them and there's no risk involved, then yes, it probably is too good to be true. So just be wary. Ask the right people. I did actually quite a big investor actually once. I had a conversation with him, and he'd said to me, we talked about his place. It was 400,000 he had locked up in it, and I says, look, if it was me personally, I wouldn't be locking up 400,000 in one property where you can only get one rent out of anything.
No.
I would be actually taking that, and I'd be leveraging it. I'd be putting deposits down and buying more buy-to-let properties and using the bank's money, and then creating more money out of that money. Therefore, over a period of 10 to 15 years, that potentially could double in value with the portfolio you've got. Rather than having the 400,000 doubling, you could potentially have, let's just say, about 2 million doubling.
Yeah.
So I would rather have 2 million doubling in property in the next 15 to 20 years even than actually 400,000 in the next 15 to 20 years. Plus the fact you'd be earning a lot more income. You'd be diversifying your portfolio as well, and you'd be diversifying your risk as well, because if one property goes down, therefore all the other ones are actually running for you, whereas you've got one property with 400,000, then if that goes down, your income's wiped out for that period.
Yeah. Yeah, people have a bit of a misconception when, I mean, if somebody's fortunate enough to have, for example, Jim, 400k in the bank, they think, well, I could buy one property and I could buy it outright, have no mortgage and rent it. And they have this thing against, oh, why would I take out mortgages when I've got cash in the bank? But because you could multiply that effect and have so many different incomes coming through. And like you say, Jim, it diversifies things and makes you less risk adverse to, like if one goes down, you've still got the rest running. And so I mean, so there is a big
it's a long-term strategy. If you're just doing short-term and you're just wanting the money for the short term, then probably buy the property, don't get a mortgage on it, and just potter about with it yourself.
Mm-hmm.
You know, just try and learn all the legislation yourself, self-manage yourself. You know, it's a hobby for you, and you know what a hobby is. If you make your passion a hobby, you'll get a hobby income. That's about it, really. And that's the difference between people that go into meteoric success and people that actually end up with just the hobby income. They both start off at the same place, but one actually understands the concept of being able to multiply that money and use a leveraging position with the banks or with another investor in order to get that. That conversation ended up at that really seasoned investor came to me and said, well, maybe I should just give you £1 million and let you get on with it. And I went, I don't actually invest other people's money. However, you actually advise them, don't you, to what they should be buying and how they should be buying it. So I don't actually have a fund, because I don't run a fund or anything like that. But we more or less just replicate what I'm doing anyway with other people, and it's in their name. So it's their sole ownership and it's their sole income, and that's how we do it, isn't it?
Yeah, definitely, and then give them that guidance on where they should be putting it ideally, and how it will work for them.
Well, I see so many opportunities coming by, and you see that as well, where there's properties that pop up, and it's like, you know, I don't want to buy 1 and 2 properties now. I just want to buy the portfolios. It's like I can't be bothered with the hassle of just doing 1 and 2s now. However, for the small investor starting out, or the one that's just a seasoned veteran, but they're just wanting to grow a wee bit more, they just want to buy 1 or 2 properties. So therefore, they always say to me, "Oh, you always get the good stuff first." It's like, no, I don't. It's like I don't buy the 1s and 2s sometimes. A lot of the times now, I just go for the portfolio. So so you get the opportunity to get the 1s and 2s by going to Richard, and he sees them before anyone else, and that's how you get in the door with it. And I went, oh, I never really thought it like that. So that's where the opportunities lie. It's like coming to someone like yourself, where you can do that. I would definitely think that's the best way to go for someone just starting out, because they've got no knowledge, no expertise. They've probably not got the time to learn anything, or learn everything they should learn, because they don't know what they don't know. Remember, they should learn what they need to learn. They don't have the time to do it, therefore they just get someone like yourself to do it for them and advise them what they should be doing and point them in the right direction. You've done that for loads of people.
Yeah, definitely. Yeah, and it does work. I think it's always good to remember, like property investing and the housing market and the stock market and things as well. They're all affected by supply and demand, which we spoke about briefly there, and that really means that prices rise and fall depending on how many people are buying or selling at any given time. So prices can be sometimes artificially inflated, like in stock markets and things or whatever, just because they're popular at that time, or do you know what I mean? And not because there's an underlying value, or do you know what I mean? So you need to be aware about what you're doing, or have somebody that you know knows what they're doing, and I think that's really important. It's like
I have no idea about individual investing in individual companies. That's why I leave it up to Standard Life to do it for me. And that's why it's a no-brainer for me. I just let that sit over a period of time. The most important point to me is a great tax deduction to get me down to the lower rate of tax when I'm a higher rate payer. So I'm saving a fortune in higher rate tax when I'm contributing towards it.
Yeah, I mean, yeah, and a good example of that is suggesting to people like invest in oil and gas or gold or pharmaceuticals or AI. Do you know what I mean? Depending on what the market conditions are at that time. But I think that the overall thing that I wanted to cover there was the chasing the quick wins isn't really going to work, and especially in property investing and things as well. You need to be patient and let things compound up over a longer period.
I agree.
And then that brings us nicely to what I want to speak about, like why does the marathon approach work? Do you know what I mean? And investing is not just making as much as you can within a short space of time. This could obviously lead to mistakes, and there's a greater chance that you'll end up losing money and having to exit the market if you're in property investing, which we've seen a lot of recently. To really see the benefits of investing, you need to be in it for the long term. And this really means a minimum 10 years, although ideally much longer. I mean, how long have you been doing this, Jim?
30 years.
Yeah.
So 30 years I've been in property, I would say. Yeah. I've been in property longer than I've probably had a pension. The pension was only, as I said, a tax deduction. It just made it more tax efficient for what I'm doing. But I know there's other ways out there to be more tax efficient. Hence the reason I'm starting to research, speaking to the right people, you know, and I'm now starting to understand who I should be speaking to get the right advice, because it's the thing about you don't know what you don't know. And even the smaller accountants don't know that either, because they're not specialists in the tax area of properties, for example, because it's pretty niche. When you look at it as accountants, in Scotland, for example, if you specialise in property, your market is literally only, 300,000 landlords at the most?
Yeah.
And most of them won't actually choose you. That's no hell of a lot of market. Whereas if you specialise in small business, then that's a bigger market, isn't it? Plus the fact that you've got the property people as well, but you don't specialise in property, you just do general accounts. So that's why you get a lot of mainstream practices just doing bookkeeping and general tax returns and filing your limited company accounts. And you probably need to go to a bigger accountancy firm to get somebody that's actually a specialist property tax advisor. Like for example, Ernst & Young. That's the one I've been reading about now. And I think I thought, why didn't I think about that before? And I just didn't think big enough. I didn't think big enough about the big four, which used to be the big six when I was an accountant. But that makes absolute sense now, because they've got specialist tax advisors in Ernst & Young and Price Waterhouse. I think it's Price Waterhouse Coopers now, is it? And Pete Marmot and McClintock, and all, you know, the big four itself. Actually know what you should be doing, how you should be doing it, based on your personal circumstances, and they know dare I say, schemes which are readily available. I mean, they're very tax efficient schemes, readily available to utilise for somebody that needs that. You know, after all, it's perfectly legal to do. It's just that most people don't know about it.
Yeah.
I was just reading up one of the guys. I don't really follow him, but I know of him. He's actually now living in Monaco, and it's like Monaco is a completely tax-free place to be. And he now, clearly, of his investment income, has probably set up a company in Monaco which actually gets paid dividends from a UK company which it owns, and potentially dividends between companies is tax-free. Therefore, when he takes his money out in Monaco, it's tax-free as well.
Yeah.
How to pay yourself a completely tax-free dividend. That's what Philip Green did with his wife. Exactly the same thing. And it's perfectly legal to do.
Yeah, we touched on that last week about we spoke the difference about tax evasion and tax avoidance and the differences in that. So, but I mean, talking of the marathon approach and things, as I was speaking about there, then historical market data can tell us a few things about whether it's stock markets or whether it's property. Or, do you know what I mean? And markets rise and fall sometimes on a daily basis, and it takes significant downturn, usually around about every 10 years or so. Jim, would you say?
I'm not really sure. I've not really tracked it. I do
But
know
then
when anything takes a downturn, usually in the next 18 months, the uplift comes, and that's when most people make their money.
yeah,
So when the
that's
market takes a downturn, that's probably the time you should be looking to invest.
yeah. Downturns potentially they always run alongside a recession and any other major world event. Do you know what I mean? The pandemic, war, and
Yeah.
obviously the recession and things. But generally, it covers fairly quickly afterwards, and the recovery is more sustained than the actual downturn.
hmm
And after the recovery, markets typically restore at quite a high point, and a higher point than they were before the downturn. So that's why I think the I'm trying to explain the marathon approach works, because if you're in it for the short term, you could get caught out there. Whereas if you're in it for the long term, things might take a downturn, but they're not really going to have effect on you because you'll still be in it, and it'll turn around again. And that's
That's why you should. That's why you should never invest money you can't afford to lose.
yes, yeah, that's a good point.
It's like a gambling thing. You only gamble if you can afford to lose that money. Because gambling should be looked at an enjoyable thing, although some people don't treat it like that.
Mhm.
They treat it like an opportunity to make more money, and it's like that's not what gambling should be. Gambling should just be an enjoyable thing. So you just gamble what you're prepared to lose. We did that one time. We actually went to casino. You started off with 80 quid. I started off with 80 quid. I lost a whole lot, and you doubled your money.
I come out with 160, yeah.
Yeah, and it's like I lost a whole
Was
lot,
that
and we just stopped at
was it
that, and that
blackjack?
was it.
Blackjack, yeah.
Yeah, something like that. But that just shows me straight away that's when you should actually stop. Whereas other people go, I'm going to try and win my £80 back. It's like, nah, just let it go. Let it
Yeah.
go. Because if you try to win it back, I've been there before, you end up losing more money, and that's not what you should be doing. You should cut your losses. Buffett
Mhm.
does that all the time.
Yeah.
The Oracle of Omaha. When he's investing in the stock market, he invests in a company, he's got a stop loss. Most seasoned investors have the stop losses. In other words, there's a time where if it drops to a certain price, they don't actually go, oh, I wonder if it'll go back up, I'll leave my money in. No, they exit and actually sell. So they've got what's a stop loss, so it stops the losses because they don't want to take any more losses, and they don't want to even stick there, because the reason it's dropping is because there's obviously something wrong, and it's not going to recover anytime soon in the short term. So therefore, they're better to exit with their money now and invest in something else. And that's why they say most of their wins far outweighs most of the losses, or all of the losses. So the majority of the wins actually, they make more wins than losses, and it it actually levels itself out with them being ahead all the time. And it's exactly probably the same thing I've done. There's been some things that, classic example, let's come back to property, the amount of money I put into some of the refurbs. It's like, you're probably not going to get your money back on the price, but you're going to get your money back on the increased rental you're going to get from it. And
Mhm.
you're going to get your money back as well on the increased occupancy rate you're going to get from it as well. So see how
Yeah.
that works.
Yeah, because you're
So you're not going to
definitely
get the price, but you're going to get the return.
because you've made these properties to a certain level. You're going to have people in here that are going to pay a bit more for it. They're going to
Mhm.
stay a lot longer because they're going to enjoy staying. Do you know what I mean? So you've got that. That's the bit. That's where you see that the benefit of the.
So you
Um,
can't go in with that miser mindset, like, oh, I've got to cut back on every single penny, and
mhm.
we can't do this and we can't do that, and that's just going to cost a wee bit too much. And it's like, I've seen people argue over 50 quid. I had it somebody recently on social media, actually, in one of the landlord forums, going on about the fact that he was getting overcharged. They felt he was getting overcharged for a Legionella testing certificate. And it was like, oh, I can, it's going to cost me £90, when in actual fact, because the letting agency did it, and it was costing them 90 quid. He says, I could get it done myself for £50. Right, but then you've got to go and organise with the tenant to get access, and then you've got to organise with the contractor to go in at the right time, and you've got to make sure they all turn up, because most of the time, or some of the time, the tenant isn't there, or the
Yeah.
contractor doesn't bother at the right time. Therefore, you're left back in that. And when you then start to monetize the time involved that you've got to do that, and the 40 quid you're trying to save, it's not worth it.
Yeah.
But
We've
they
got
get into that mindset.
yeah. We've actually a good way around that, and we've got a contractor who does he does the gas safety and Legionella all as one,
Yeah.
and that kind of gets around that cost wise, and basically, well, they're doing the gas there anyway, so if it needs done anyway.
But then I come back to saying to myself, it's like, if you're sitting worried about 40 quid extra that you're getting charged, you're maybe in the wrong business.
Yeah.
It's
Yeah.
like there's a serious problem there if you're focusing on just 40 quid, because the bigger picture is thousands in comparison. And that's what you should be focusing on, because that time that you could have had back, you could have gone out and done something else, which
Hmm.
could have made even more money and actually cemented more effectively, passive income for the future
Yeah.
with one other deal that you could have got in that period of time. Maybe you've got 10 of them, and it's 400 quid for extra to pay the manager, the property manager, to do it for the 10 of them. But when you think about the time, that's almost about 20 hours, because it's about 2 hours at least to organise all that and put all that together for each one. So that's about 20 hours. So that's 20 hours you could look for buying more property. And what deals could you do in 20 hours of your time,
That could
which could
generate more
then,
income stream.
yeah, it could generate a hell of a lot more income in the long term, and also wealth building as well. And that's the type of thing you've got to think about. That's a real wealth mindset.
Hmm.
Not this, oh my God, I need to keep everything myself because that 40 quid could make me more money. It's like, but you've just lost all that time. And the
Yeah.
time's probably more valuable to you because your time, it's only if your time's restricted, if you've got all the time in the world. This is why I said about one person managing their own property and learning it
Hmm.
all themselves. If you've got all the time in the world, just fill your boots and do it.
Yeah.
I'm talking about linear programming in terms of scarce resources, and in my mind, I'm working out which is more cost effective for you in the medium to long term, and it is actually taking your time as the most valuable asset, and not the money.
Yeah. Yeah, definitely. And you touched there slightly. You spoke about people obviously cutting their losses. I mean, and it brings me on to the next bit that I was going to talk about. I mean, should people be cutting their losses? And then there are a lot of people that have, and there's a lot of things that are going on. But I mean, as trying to avoid further losses, could that not sometimes be as just as damaging as trying to chase a quick win?
I
Um,
think everybody should get out of property and just leave me alone.
yeah, I mean,
And
I think.
when people start saying I'm exiting, I'm selling up, I'm going, yeah, beauty, this is getting better.
Yeah, I mean, I know there is certain people that maybe their individual circumstances do warrant them having to exit market and things, especially in property and that. But I mean, it's only natural to get nervous during a time of maybe downturn or whatever the factors might be. But selling everything to avoid losses can sometimes maybe be a wee bit counterproductive. Um, and choppy waters in any kind of market um, mean that you will experience obviously dips in the market, and then you will be maybe susceptible to maybe upswings as well. But the probability of following these things through, and then the probability of you being okay at the end is. Do you know what I'm trying to say? That obviously there's always going to be ups and downs, and people when they come to a down think, all right, I'm out, and really that's not the answer. You should really stick it out.
Learn to understand the long game, isn't it? It's
Yeah.
learning to understand where you want to be. It's then focusing on where you want to be and how you want to get there. And often a lot of people leave prematurely. I talked about in a recent
Yeah.
podcast with the video solutions guys, the property video solutions down south. I was on their podcast and I said it's amazing the amount of people
That
that
was Chris.
head for the finishing line of 100 meters dash, and then when they get to 99 meters, they stop, and then that's it. They didn't even cross the finishing line. And that's like people that sell without any actual analysis of where the medium to long term can go for them. And the fact that look at their circumstances right now and understand that that's probably a short term blip. It's
Hmm.
neither here nor there in the scope of things in the long term program, and therefore that's why they should probably hold on to it. I nearly did that, didn't I?
Yeah.
Just before the pandemic, I was like, okay, I'm probably going to start exiting. I'm probably going to start selling off now. And then I woke up 2 days later, one night and thought,
What am I
are you
doing?
off your head? Are you off your head?
What am I thinking
You're
about?
off. You're off your head. It's like flipping heck. Do you realise the long-term wealth generation and the income that you'll generate and pass that on as a legacy to your children?
Hmm.
And there's nothing else that comes close to it. Are you nuts? And then I took a change of heart and went and ran out and bought 20 properties
Yeah.
instead.
Yeah.
And
I
then I've
think.
got another 30 in the pipeline.
Yeah, we do. Yeah. Well. But then I think it's hard to predict the timings of things in the market and things. But I think that really you need to be in the market to benefit the ups, but that means also suffering some of what goes on when it's down from time to time, and it's just the natural progression of things, and you need to be in it for the long game to reap the benefits of the ups. You have to take the downs with it as well.
Absolutely, yeah.
And then
there's always going to be ups and downs and everything. It's a classic example. There's always winners and losers. If somebody wins, if somebody loses, somebody's got to win. And it's because there's only a finite amount of money in the economy, so it has to go somewhere to someone. So if someone else is getting that £1,000, then someone else is losing that £1,000. But the object of the exercise is how to attract that money to you rather than someone else. And it's the people that a very famous property investor says it: the person that gets the most attention makes the most money.
Yeah,
I agree with that.
And would you say it is a good idea to keep maybe like a cash buffer, or something there, so you've maybe got enough money to deal with emergencies or things that do you know what I mean, are unforeseen?
Yeah, every single time. I mean, I flew close to the sun quite a lot in the early days, and I wouldn't, it's no for the faint-hearted doing that. You do encounter a lot of stress, and it takes a big toll on you as well. I suppose it's a price if you have to pay. But when I say about sailing close to the sun, or flying close to the sun, if anybody knows the story Icarus, and flying close to the sun.
Candle wax he used.
I think. Well, he'd used candle wax to put all these feathers on to be able to fly, and they didn't realise is when he started to fly close to the sun, it melted and he fell down to earth and killed himself and died. And effectively, that's what a lot of investors do. But I didn't. While I thought I was doing that, I wasn't really doing that because I had so much tolerance built into my equations. Into my calculations every single time. And I mean, for interest rates to go significantly higher, for occupancy rates to drop significantly lower, for rental levels to drop lower, for repair bills to get higher, I had all these tolerances which I was able to handle. Therefore, I wasn't really flying close to the sun at all. But I felt like I was a Monte Carlo or bust sort of person. But I was always building all these tolerances in every single time in order to protect myself against any swings that I can't control. For example, base rates going up and interest rates going up.
Yeah, I think also as well with property investing, I think it's important, and people always think of this wrongly as well. When your portfolio value actually drops, it's only the actual individual units or the individual houses valued. But if you've got that income stream coming through,
it
then it doesn't make any difference, because then it'll do full circle and come back around again. And if you're in it for the long term, your house is going, your value will return in your house. Do you know what I mean? The capital will appreciate again. But through that whole time, you've still had the same cash flow. Do you know what I mean? You still had that. So
every single time. The cash flow doesn't change, and this is what a lot of people don't understand. It's like it'll recover anyway. It'll not make any difference. There's no need to panic and exit.
Yeah.
But just people actually think that affects their income by the price it dropping. And it doesn't. It makes no difference if you're still making income out of it. If the market's still buoyant and the occupancy rate is still high, and the person's paying the same amount of rent, then by all means do that. But you could have built a big cash reserve where you could actually bring your liquidity back online. You could actually pay off some of that debt then if you wanted to. And that's the advantage of actually probably just storing all your money when you actually make it. And that's effectively what I'm doing. I'm actually putting it back into repairs and improvements, I just keep it lying in the company just so I know it's there for when I could use it in different ways. So that's kind of how I look at things. The money it's generated in my portfolios was really not for me to spend. It's just to keep reinvesting. It's a fund. What I make from day to day, my job is my living, and a wee bit of my lifestyle as well now, because I've made a bit of money out of the company, and I have taken, admittedly I have taken something out recently, but no significant amount in comparison to what the actual fund is itself. But I kind of think after 30 years, I think it's maybe I deserve a bit.
Would you say it's better not to look at your actual investments too often? If we take properties and property price, for example, you get these people who are quite meticulous. They keep checking on what their property values are when they're doing property.
Yeah, there's no point in doing that. There's no point in doing that because property prices aren't moving that significantly.
Yeah.
The only way you need to check on your property value is if you're actually doing the significant improvements to it to reassess it to see where the revaluation is. But just looking at every single day or every single week isn't going to make any difference to your overall long-term prospects. It's just going to waste your time. I think they just need something to do, people like that. They just need something to do, like just go and get a job with someone else then as well at the same time and make money with that. And that'll provide for your day-to-day living and keep you busy.
Yeah, I think it's the whole, if it's not broken, don't look to fix it. Do you know, if you've got,
No.
Yeah. If you've got a cash flow
Definitely
curve with property and things, just let it do what it's doing.
The only thing I keep an eye on is the cash. You've got the cash in the bank and you've got enough, then you're fine. As long as the cash is there and you know what the outgoings are on a fixed basis every month,
Mhm.
as long as you're covering that, you're fine. As long as you've got at least 6 months to cover that. 6 months you could turn things around within 6 months easily. So as long as you've got 6 months cash flow to conserve, that's kind of financial freedom. That's what the determinant is.
Yeah, definitely. So we're going to finish up today, Jim. I had put, I think it's fair to say, and I think a good analogy is to be the tortoise rather than the hare in this kind of investment. If you're investing, and be patient and things as well. And I broke down a couple of top tips that I've put in here, and I'm sure you'll interject as I go through them. But I think, firstly, I think if you decide on some goals on how you want to build an investment plan and things, and build it around those goals and where you want to be, and I think knowing what you want to achieve will make your decision process easier.
Yeah, definitely.
Yeah.
Not just saying I mean, the worst thing in the world is to say I just want to invest in property. Like, okay,
there has to be a reason
you have to know why you're investing in it. What is it you want to achieve? Put it in detail, and then it will determine whether you should be investing in property or not.
Yeah, I think as well, if you don't have a plan or a goal in mind, then you'll never ever reach that. As if you have that plan or that goal, then you can work towards that, and then that's ultimately where you want to be. And it's the journey on the way to getting to that goal. And the likelihood is you'll probably get to where you thought you wanted to be, and then have new goals and keep going. So the journey continues.
Yeah, that's the classic one talk about climbing the mountain. You know, when you get to the first summit, you kind of think, oh no, I've got another one to climb. But you actually want that. You don't want to arrive at the summit because then you've got nowhere else to go there. So you need to have, that's where people talk about short-term, medium-term and long-term goals. And that's kind of what that is. Now, if you don't have that, just go and do something and start with your goal in mind about what you want to achieve. And then you'll start to work out what you want to do next after that on the way. But just don't leave it till last minute.
Yeah. And also, I think make sure you're investing within your tolerance, capacity and willingness to maybe cope with like the risks involved, the volatility that we spoke about as well. I think it's very important to think about your tolerance and your thresholds when you're investing, and make sure the numbers work. That's a good one as well. The numbers don't work at the beginning. Yeah. And also, control what you can, including obviously reducing costs, investing tax efficiently, spending wisely, and sticking to your plan as well.
Yeah, this is where I talk about getting a property agent to actually manage your properties. And people think I could save. Say for example, the property agent is I don't know, 80 quid a month, 100 quid a month. Say 100 quid a month, make it easy. It's not 100 quid a month to you. If you're a low rate taxpayer, it's only 80 quid a month in real terms, because if you were doing it yourself, you'd have to pay tax on it. So because you're getting an agent to do it and you're paying them 100 quid, you're actually getting 100 quid deduction, which is a lower rate 20% tax that you'll not pay on that money. So you're only paying 80 quid really. If you're a high rate payer, you're really paying 60 quid. You're not paying 100 quid. Because you're getting tax deduction as well against 100 quid against your income. Therefore, it's bringing it down. And you're getting someone else to do all the work for you, so it's effectively costing you 60 quid because it's a deduction. Whereas if you're doing it yourself, you'd be paying the tax on 100 quid, so therefore you'd be losing 40 quid. See how that works?
Yeah.
So that's why it's important to really put it into stock about, understanding your numbers and understand where the wealth is generated, and actually focus on that the most. Yeah, the wealth can. Most people, when they property invest, buy a rundown property, they put a lot of effort in themselves in order to regenerate it, and then they lock up the capital that way by refinancing it and getting all their money back out. That's the rinse and repeat formula.
Yeah.
And that's where they'll generate their wealth in the beginning, because they're basically able to take the money and then do the same again and same again and same again. And it's a good strategy. I did it in the beginning as well, and I still do it today. So it's a really good strategy.
Mm-hmm.
But you've got to be patient to do that. That takes patience. You can't get these deals all the time. They're just sometimes non-existent. You just have to be patient, wait your time, and prepare for the opportunity, and keep learning as well. And that's when the opportunity arises, the point of readiness will happen.
Yeah, point of readiness is a really important thing, and you talk about it all the time, Jim. And you see people that, like you say, rushing in, really eager, and that's good, but they're maybe not at that real point of readiness. And that you need to be able to identify that and know when you're actually ready to.
They've not got all
take.
the facts. They've made their decisions based on what they think they know, or what they think others know, and therefore the others don't know about their personal circumstances and personal goals. Therefore, they make a rash decision and they make the wrong decision. So it's about having the right information from the right people based on their full picture of their circumstances and what they want to achieve.
Yeah. Good. And I think, and finally for me, and I know you'll agree, Jim, and hopefully people watching will agree as well. But
I might not.
You might not, but I know you will. But I think, do you know, if you've got all of this, and
That's a bit presumptuous.
And maybe you are at this point of readiness, but I think the last point I put in here was to take care of your health. Spend time looking after yourself, because you could have all of this and maybe create all this wealth and maybe not looked after yourself, and you might not even
tell me about it.
might not even be around to enjoy it. And spending time with like family and doing hobbies and keep yourself, do you know what I mean? Your mind and your body as well. Your health.
That's where it comes back to the there for the grace of God go I. It's like, yeah, I've been there. Definitely. I think your health is probably the most important thing. There's no point in generating all that wealth and all that money, and the fact is you die early because you've tried to do it. Unless you're determined to pass on to someone else. You know, and that's what you see your whole prospect is. And I speak from experience. That's how I was, and that's how I still am. I'm just a caretaker for what I've got, and it'll pass on to the next generation, and they'll be a caretaker for it as well till it passes on to the next generation, and they'll get the beneficial interest of it. And just now, I'm starting to get the beneficial interest of it as well. So that's what the plan is, the master plan.
Yeah, and that's, like I say, as we say, back to planning and goals and what you've been working toward all these years. So, and that's it, really, for today.
Brilliant. Thank you very much for hosting the show. Really enjoyed that. I hope everybody else did.
I hope everybody took something good for there. I, of course, can be contacted anytime. My email, I think it's in this. Is it in the post? My email is richard.good.
More than likely will be.
At fiveproperties.co.uk. And we'll be back next Monday. Jim, are you still going to be away next Monday?
Yeah, I'll still be away. I'll try and pick another destination.
Right, okay, that's good. But we will be back next Monday at 12:30 as usual. All right.
Okay, bye-bye for now.
Thanks, Jim. That's great. Bye.